Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Hormuz Fatakia. Minor gains as we start the show at 11 o'clock. The Nifty and the Sensex are higher by close to about 0.2%. The Nifty inching towards 24,600, 50 points up. Sensex gaining 160 at that 80,900 mark. The gains pale in comparison to the rest of the Asian markets, which is surging now. So leading the gains today is the Korean markets, 2.5% up on the Kospi. Following the election of the Liberal candidate who is expected to introduce pro-growth reforms there. So this political shift has lifted gains in Kospi. But even the other markets, whether it's the Taiwanese markets, the Nikkei market, all rising. And plus, I think the US dollar has also eased considerably. The dollar index is down, I think, to a 5-6-week low. So that's pushing up the Asian markets. But back home in India, things are still very much range green, but minor gains.
A couple of positives actually for the overnight markets, at least when the Wall Street handover was a positive one. There's some positive data that came in on the jobs front as well over there. So Wall Street did fairly well for itself, and that led to a slight rebound in the dollar as well from levels of sub 99. The dollar index is back above the levels of 99 as we speak. So heading towards that mark of 100 yet again is the dollar index, but it's not quite rubbed off on our own markets. Yes, as Reema was just highlighting, we are trading in the green, but it's not a significant green as of now. But we do remain above that 24,500 mark. We've been managing to defend that for almost a month now, and that is the important level that we need to keep an eye out for. Yesterday's low, of course, 24,502, and then 24,462, which is the low that was made on the 22nd of April. So that is the two important levels on the downside that we need to track. Of course, tomorrow is expiry. Friday is going to be the MPC rate decision. So there are a lot of other factors that our own markets need to consider for any further direction. Of course, there was a slew of block deals yesterday. There's a slew of block deals today as well. Aditya Birla Fashion, the top loser on the Nifty 500, still 9% lower. Indegene is down 4.5%. So those are the two negative ones. Motilal Oswal also had a block deal earlier in the day. That stock is trading with gains of around 3%. But it is Garden Reach Shipbuilders that is surging, and surging how? 8% higher on that stock today as well. So good going for that. And Masgao Dock, of course, and Cochin Shipyard, some of the other gainers. But Bharti Airtel is something that we're putting the spotlight on, and that is because of a note that Macquarie has put out, Reema.
Indeed. So Macquarie is bullish on Bharti Airtel. They've raised the target price to 2,050, and that is a 14% upside from the current level. In fact, they're in a bull case scenario, they even see the target price rising to 2350. Bharti also features in Macquarie's India Super 6, its core stock picks list. Now getting back to what they've done. So basically, Macquarie has introduced various scenarios and they've assigned a probability. So they're saying in a bull case, the ARPU of the company, average revenue per user, rises to 300. In a base case, it rises to 290, and in a bear case, it rises to 275. This is still higher compared to where the Q4 ARPU of 240. So ARPUs are rising, it's just the growth rate, right? Bull case 300, base case 290. Now they're saying that there is a 50% probability that the base case plays out. And if that happens, then the target price is 1,920. A 40% probability of a bull case, your best case scenario in Bharti Airtel, and there the target price is at 2350. So what they've basically done is a weighted average across various scenarios and come up with a target price of 2,050, which is where the new target price is. They've also highlighted, what is driving this. It's basically, as you can see, the free cash flow is higher. The ARPUs are going to inch up because of industry discipline. And they've also spoken about two catalysts. One is Jio's potential listing, which will be supportive for sector multiples. And two, the industry tariff repair playing out. Basically, tariffs continuing to inch up from these levels. So, bullish note, Macquarie is dialing up Bharti Airtel, and stock is higher by 1.5%.
It's been one of the outperformers this year, has Bharti Airtel.
Your 3-year return is 165%.
Wow.
So just imagine that, like we're talking about a CAGR of 50% last 3 years.
The returns are almost on par. I can't say really on par with the ARPU, but yes, very significant returns over the last 3 years is Bharti Airtel, and of course some more value creation with Bharti Hexacom as well. So that is a double bonanza for the Bharti twins as we speak. So 1.5% higher on Bharti Airtel, 35% over the last 1 year, but has been a significant outperformer in 2025 itself, among the top gainers on the index. But it was, we were just mentioning about block deals. There were plenty of them yesterday. There are some of them today as well. And Vivek is here to take us through those block deals. And of course, we are being joined by our other teams as well to talk about all the other buzzing stocks. But what's buzzing more are the block deals. So Vivek, over to you first. Take us through the block deals that have taken place today.
Well, earlier today, our colleague Nimesh and myself highlighted that quite a few blocks were on offer. Yesterday, we saw multiple block deals happen, and that trend continued today as well. So the first one on the list is AB Fashion. So what we understand is that, now remember, the entity that is currently trading is the demerged entity. The other one is yet to list. So Flipkart, post the demerger, held close to 6% stake in the company. And according to the term sheet we accessed last evening, they have sold the entire 6% stake in the block deal today. Over 600 crores worth of stake is what Flipkart has gone ahead and sold in AB Fashion. The other one is Indegene. Very interesting. Remember, software, healthcare vertical is where Indegene lies at. So this is the pre-IPO investor, private equity investor, Carlyle, that held over 10.2% stake at the end of the March quarter, has decided to completely exit their stake. So when you're looking at Indegene, over 1,500 crore of equity sold hands, and post today's block, there's no more overhang of the private equity investor selling. Now coming to Tata Tech, again over here too, it is a clean out trade. TPG rise. Remember, at the end of the March quarter, they held close to 6%. In April, they sold close to 4.9%. And within a month, they've actually gone ahead and sold the remaining percent. So as far as an overhang from the stake sale is concerned, that goes away. But despite that, Tata Tech today is under pressure, and almost 2.1% of equity exchanged hands in the block deal window today. And lastly, Alchem Labs under pressure. This on account of the fact that the promoter entity, now this promoter by the name of Jayanti Sinha, trimmed almost 1.4% equity. And on the account of that further paring of stake by the promoter entity, you are seeing Alchem Labs almost 2% lower in the session today.
Thank you very much for that. Perhaps this is the reason, right? These large block deals, equity sales by the PEs or promoters, it's just led to so much secondary equity supply, and it could explain India's underperformance vis-a-vis some of its Asian counterparts. But let's talk about the defense space, and one stock in particular, Garden Reach Shipbuilders. This is after signing an MOU with a Norwegian company. The share price is surging. Ria joins it.
Well, yes, Reema, GRSE is in focus once again today, and after they have signed an MOU with Norway's Kongsberg, and this is to, as a result of which India is going to build its first ever polar research vehicle vessel. This vessel will be built at GRSE's yard in Kolkata, and the National Center for Polar and Ocean Research is going to use this vessel for research activities in the polar and southern ocean realms as well. Now, at the signing of this MOU, Union Minister Sarbananda Sonowal had held a roundtable with Norwegian ship owners, and he has invited investments into India's maritime sector as well. And at the signing yesterday, he also said that Indian shipyards currently hold about 11% of the Norwegian Ship Owners Association order book, and he has also urged for further expansion of orders into India. Now, GRSE's current order book, including the recently signed NGCs, is likely at rupees 47,680 crores. The order value for this vessel today that has been signed has not been disclosed yet, but overall positive news flow for GRSE, and the stock is up around 8% on the back of this.
Record high as well for Garden Reach Shipbuilders, almost nearing 3,500 now. Garden Reach has become the second company to have doubled in 2025. So good going for Garden Reach. The NACL Industries is the other one. And since we are on the subject of shipbuilders, actually, even Mazgaon Dock today at one point was up 3.5%, and at that point its market cap was around 1.5 lakh crore. It was more valuable than 8 Nifty companies put together. So that is the kind of moves that we've seen in these companies. So it is the shipbuilders that are continuing to hog the spotlight in today's session as well. But from stocks that are doing well to a stock that has been completely bombed out in today's trading session, and that is SPARC, and Sun Pharma Advanced Research Company, and Ekta is here to tell us what is leading to so many sparks here. Ekta.
Well, yes, the news is with regards to Sun Pharma and SPARC. Now, Sun Pharma announced the top-line results from phase 2 trials of their molecule under development SCD-044, which is basically being studied for psoriasis as well as atopic dermatitis. And the drug did not meet primary endpoints in either of the studies. So the development of this particular molecule is now being discontinued. There is no further clinical trials which is being planned. Sun Pharma and SPARC will together assess what the next steps for this compound would be. Now, the impact for Sun Pharma is not as much as it is for SPARC, because for Sun Pharma, this is a part of the specialty portfolio. For SPARC, it was one of the most important molecules in their entire pipeline. So SPARC had licensed the molecule to Sun Pharma. SCD-044 was in phase 2 and the results were due in Q4 and Q1 of FY26. The stock has run up over 70% from March to June of 2025 in anticipation of what these results could have been. So analysts say that this is one of the more advanced molecules for SPARC in their portfolio. Now, going forward, a couple of key things to track for SPARC would be the other molecules in the pipeline, such as SCD-153, 154, so these are a little more nascent in terms of the portfolio. Also, largely, the company is looking at cost cutting. So, for example, they're looking to cut manpower costs by around 30%. Additionally, the other factor which they have mentioned in their investor presentation as of December of 2024 is that the available debt and cost optimization provides a runway for them till May 2025, and the expected milestones are expected to defer the imminent need for fundraising. So what happens when it comes to fundraising now would be something that the street would watch out for. Overall, stock is corrected around 35% from its 52-week high, which it hit in July of 2024 at around 257 odd rupees.
Ekta, thanks a lot for that. Not good going for SPARC, the top loser on the BSE small cap index today. 18% lower now on SPARC. At one point was down 13, has now extended its losses, is down 18%. By the way, PI Industries has now surged to the highest point of the day after its key customer Kumai has raised its outlook for the year, and that has rubbed off positively on the stock as well. Now 3.75% higher for PI Industries. Take a short break. On the other side, we discuss all things commodities with Manisha Gupta. Welcome back. Shifting focus now to commodities, and Manisha is joining in to focus on the yellow metal gold. Manisha.
Well, yes, and that is because we've seen stronger gains continuing for the last couple of days. Now we're just about $150 away from all-time high of $3,500 an ounce, and gold prices have gained up by 29% in this year until time. Well, the markets clearly are cautious ahead of the potential Trump and Xi Jinping meeting, and if something does come out of that. But ahead of that, we've seen buying continue in case of gold. The ETF buying, the gold fund buying for the month of May has been on the stronger side, and that perhaps seems to be finding its way in June numbers as well. Also, the Russia-Ukraine hostilities have just about continued, even as there is conversation about peace talks and a couple of meetings that both the countries have had. Markets are not taking much, markets are actually taking premium out of that as well. And then Iran's statement hinting towards rejecting the US nuclear proposal is yet another thing that the street is looking at. The OECD lowering the global growth numbers also is something that's found its way. The money found its way in case of gold there. And then weak manufacturing data coming in from China, the lowest in last 2 years. So everywhere that you look in sense of whether it's about tariffs or increasing debt in US and all of these geopolitical tensions, tariff concerns, weak economic data, it all seems to be helping gold yet again. And even as we've seen some bits of profit taking here and there, gold has not broken below 3,200 once it crossed that number. So that is where the support on charts also seems to be coming in from. It is all going to be about the US non-farm payroll data. Well, that comes in on Friday. But ahead of that, there's a bit of a buying there. And further course, of course, will come after that data.
Thank you very much for that. Moving on now, we're very, very excited to unveil a brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights From policymakers, business leaders, economists shaping both the world and India's future, CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime, 12 noon for the Global Reset, Global Lens at 8:30 p.m. Welcome back. Real stocks are in full speed today. Ircon 6.5% higher. Texmeco has moved up nearly 6%, and the other two are Railtel and RVNL. Let's get all these stocks up, and you can see the up move at the day's high right now. So that's one pocket of interest, even as the indices are holding up with small gains. Mitesh is now with us for a quick technical check on the markets. Mitesh, quietish session. What are the trades that you've taken? What is the advice that you would give on the index and individual stocks?
Yeah, I think a very quiet session. And, ever since we've gone into that range, I think markets have been slightly less choppy on an intraday basis, barring yesterday when we had some kind of a decline. But broadly, as long as we are holding this 24,500, 24,450 zones, I think we should be okay, and eventually we should bounce back. You were talking about rail stocks. In fact, I have IRFC as one of the recommendations, just getting past its 200 average right now. Buy here with a stop at about 141.5 or 140.5, and a target of around 150 can be looked at. So that's one of the rail stocks, which I like a lot. The other one is from the banking pack. We've had buy calls on this earlier as well, but AU Bank is a buy with a stop at about 719 for targets of 750.
Mitesh, since you were on the subject of railway stocks, I'll quickly slip in a defense question as well with the shipbuilders, right? With the kind of moves that you're seeing with them, the charts almost become, or everything just becomes irrelevant, right? With the kind of Garden Reach up 80% in a month, Mazgaon Dock up 60%. What are the charts indicating here for these names, be it Mazgaon Dock, GRSE, Cochin Shipyard?
So they've already had a very good run for us. I think, they still look good to me, but from a risk-reward equation, I think, wait for some kind of pullback. We've seen Mazgaon Dock taper off from levels of around 3,750 to about now at 3,450. But I think a good entry point, because the stock rallied from 2,200 to about 3,800. A good entry point would be around 3,250, 3,200 zones. That's where the supports come in. GRSE still is going very strong, and the stock is very far away from its 10-20 day average. So I think, these stocks are good if you have to hold them, but if you want to enter a fresh, wait for a 5-7% kind of a pullback to enter.
Generally, is there any trade when stocks get compressed because of large block deals like we are seeing today? And Aditya Birla Fashion Retail or in Indegene, Tata Tech, because today the stocks particularly have weakness going for themselves. Is there any kind of an opportunity in that?
See, Tata Tech is something which I like a lot. Indegene I'm not tracking, unfortunately, but Tata Tech is something which has a rally, looks like giving a pullback. I think get it if you get it around the 744 to about 735 kind of range, buy then with a stop below 730. I think the stock will retest 780 and eventually go past that as well.
A lot of supply coming in with a lot of these block deals. Mitesh,
at least in Tata Tech's case, TPG is completely sold out. It was a clean out. Yeah, so that overhang is now out of the way.
Mitesh, thank you for sparing time and joining us today. Views on the index and specific stocks as well. But the bigger news that came in last evening, other than the block deals, of course, was the fact that market regulator SEBI has cleared HDB Financial's IPO, a 12,500 crore issue. And this is, of course, being in compliance with the Reserve Bank of India's mandate for an upper layer NBFC. Ritu is bringing in more details on that for us. Ritu.
Well, SEBI has finally greenlit the much-anticipated 12,500 crore rupee public offering of HDB Financial Services, marking one of India's biggest public issues this year and one of the largest by any NBFC in recent times. Now, the IPO comprises of 2,500 crore rupees of fresh issue and 10,000 crores of offer for sale by the parent HDFC Bank, which owns more than 94% stake in the company. But even after the IPO, HDB will continue to remain a subsidiary of HDFC Bank. Now, the listing is not just strategic, it is also regulatory because HDB has been identified as an upper layer NBFC by the RBI, and that mandates a public listing by September this year. Also, if RBI's 2024 draft norms on overlapping financial services are enforced in the current form, HDFC Bank may need to cut its stake to 20% in HDB or merge operations or so on. So that's also potential uncertainty to watch out for. Now, the IPO proceeds will be used to bolster the company's Tier 1 capital, support future lending, and so on. Keep in mind, HDB Financial is the first HDFC Group company to go public in nearly 7 years. It has more than 1680 branches across India, a diversified loan book primarily in the retail and SME segments. Now, Macquarie Research estimates that at a listing price of, let's assume, 1,000 rupees, HDB Financial will trade at an FY26 price to book multiple of 3.7x. That valuation could rise to 4.8x at 1,300 per share price, and so on. Now, if you look at the key strengths, of course, the strong strategic and operational linkage with parent HDFC Bank, as well as the well-established presence in granular retail lending and a diversified funding profile and comfortable capital structure, but it does have moderate asset quality with exposure to unsecured and riskier loan segments as well.
Ritu, thank you very much for that. I think it is 12,500 crore of IPO size. It will be the largest ever NBFC IPO in India, at least. Ritu, thank you very much for that. Get into a break on the other side. Market fundamentals with Ashi Anand from IME Capital.
Welcome back. Now, Tata Motors has unveiled the much-anticipated Harrier EV, an all-electric SUV, and it redefines the premium SUV segment with a pure EV architecture and a software-defined experience. Now, Rachna Dhanurjani spoke with Shailesh Chandra, the Managing Director of Tata Motors, on this. Listen into a slice of that conversation.
We look at EV as an industry. We're going through what is undoubtedly a slowdown. We see that translating in companies' market share as well, and as we saw, Tata Motors' market share has also been affected for the last year and a half. But at the same time, we're seeing other companies like a JSW coming up with a very different ownership model where they use battery as service. What is your take on that? And with Tata Harrier.EV, what are the strategies you are putting in place to retain and gain more market share?
Okay, so battery as a service, I have responded to this earlier also because we had explored this 3 years back also, and we felt that the model does not make sense because you are splitting the car financially into two parts. It's not that physically the two things are, separated, and you have a higher GST on the battery as compared to when you integrate in the car, it is at 5%, that would be 18%. So financially, it's a hassle to split your financiers also into two, and therefore we felt it is not going to change the monthly charge that a customer has to pay, whether it pays for the full car or when it is split into two cars. So I don't see it as making sense. My understanding and information is that it has not taken off well. The penetration levels are very low as far as bus is concerned. So market share was supposed to fall. We were 85%, 75%. Good that we are losing market share.
But now
because
down to almost 50.
Yeah, which is okay. And that is my steady state mid to long term market share ambition is 50%. Globally, the best players in a market, in a healthy market, is about 25%. The market leader, I'm saying. We have ambition of keeping 50% because the concentration and brand consideration is very high towards a market leader brand. And therefore, 50% is what we have from a mid to long term strategy. And to do that, we'll have to ensure that every sub-segment that is getting created in the electric vehicle, we are creating enough compelling proposition for all the products that we have in different segments, ensuring that we have 50% or more market share in each of these segments.
What would be your favorite feature of the Harrier? We do this with you every time there's a launch. What is it that you love about Harrier?
You know, of course, two I would choose because they are very close to each other. One is the Dolby experience. Along with that, it's very theater-like. That one experience is what I liked. The other one is definitely the convenience of auto parking. And we have gone through several cycles of maturity before we launched the product. That's damn good from a convenience perspective. But that's when I'm driving the car, right? Or the car is stationary, you're charging the car and you're enjoying the Dolby experience. I might, also, last one I would like to say is also the ultra glide suspension. When you sit in the car, because I also drive the Safari Ice. When you sit in this car, you can completely see the difference that it just gobbles, the undulations on the road. So these are so I took the opportunity to push in two more. So
now, you recently had a high-level meeting with the government about the whole hybrid ecosystem that we're seeing is being pushed by the government as well as other players in the industry. But we know your stance on hybrid vehicles from our last conversation on CNBC-TV18. Has it changed? What's the update there? Is your perspective still the same on hybrid vehicles?
So I'll not comment on the first part that you said that I have met the government. So I don't know where this is coming from. But yes, our stance on, hybrid has been very clear, very crystal clear that there are several technologies which will be there in the transition to a zero emission world. And we will choose the technologies which we feel will be the right mix depending on the choice of the consumers in the market. Today we are possibly the only manufacturer which is giving the widest choices of powertrains: petrol, diesel, CNG and electric. We know that long-term destination for auto world is zero emission technology, which is the BEV currently. Our request from the regulation and the government has been to support those technologies, which is the destination technology.
Right. Lastly, most companies in the industry are also sort of worried about the impact supply of rare magnet would be disrupted from China. What is your take on it? Are you worried?
Frankly, from Tata Motors perspective, there's no immediate disruption that I see. I would be wrong in saying that we don't have dependence on this. There is dependence. As SIAM president, SIAM as well as ACMA both are very closely interacting with the government. Government has been very supportive on this issue, in terms of reaching out to the Chinese government also, the relevant ministries there. And we hope that the issue might be, taken care of or addressed very soon.
Well, that brings us to a close in this edition of Trading Hour. From the entire team, thank you for watching. Welcome back. Now, India is a very inexpensive and cheap market. That's the word coming in from Morgan Stanley's Chief India Strategist, Ridhim Desai, in a conversation with my colleagues Surbhi and Nimesh earlier today. Listen into a slice of that conversation.
The decision on setting up a local manufacturing facility in India, I don't think has much to do with the tariffs that President Trump is proposing. A lot of these plans were already underway pre-April, and I don't think are changing dramatically because of the tariffs. There may be some delays because people want to have clarity, and that is exactly why global growth is slowing down. Because companies are pushing back on their investment plans, just waiting to see how the environment pans out in the next few months. That aside, there is really no impact on these investment plans. India is still a favored destination for what we call as China Plus One. And one of the primary drivers for that is what I mentioned earlier, that India's home market is very critical to a lot of multinational corporations. You look at the industrial companies from Europe, and they're all telling you that India is going to be a big driver of their growth. You look at the electronics sector, you look at phone companies, India is a major part of their growth, and likewise. So that has not changed on April 2nd. So that story is continuing, and India will continue to attract. That said, one thing which we need to bear in mind is India is not becoming the next China. I don't think the world has appetite to create capacities like it did in China in the last 20 years. The unfortunate thing is that the world is heavily indebted and is aging. And therefore, growth on a structural basis for the world at large, ex-India, is likely to be a whole lot slower than it has been in the last, say, 15 or 20 years. And therefore, the appetite to build large capacities is not there. But the appetite to diversify supply chains, the appetite to build facilities in India to cater to India's home market, that's clearly there. Okay. So India's manufacturing share of GDP will rise, but you should not be holding your breath for the next China. It's not happening, in my view.
Which is fine. Take your point on that. Then let's talk about earnings. And I think in your latest review, you do speak about how, because of a confluence of a lot of positive factors, you're expecting on a sustained basis, mid to maybe even high teens earnings growth. And I think that's a little above consensus, going by other estimates on the street. What makes you confident that earnings are coming back?
I'm never confident. I'm always skeptical. but we are in an earnings upcycle. Very simply put, earnings tend to move around the nominal GDP trend. The nominal GDP trend in India is largely a straight line, except for the COVID dip and things turn a little bit bad. But that's those rare things that happen. And earnings, of course, do this. So earnings don't go up in a straight line, and we are somewhere here right now. Trend line GDP is here. So this damage happened between 2011 and 2015. Earnings fell well below trend. And now we are playing catch up. And then again, we got a bit of a setback during COVID, and now we're playing catch up. So the likelihood is, and it's very simple mathematics, earnings will catch up with nominal GDP and then go above it. And then that will be the peak of the cycle. I think we're somewhere halfway through that cycle.
We're still away from that peak.
Yeah, we're somewhere halfway. We consider the COVID bottom as the start of this earnings cycle, though I do think the earnings cycle started slightly before that, but COVID has distorted the data.
Rhythm, you spoke about, market wants to go up, and you highlight a lot of things. The other factor has been the technical factor of supply of paper. We've seen massive blocks and massive promoter and PE exits in the last few weeks. How do you read that developments, and is that a red flag according to you?
So, Nimesh, two things I'll say. Is that most people thought that if the mid-cap index fell 20-25%, retail will run away.
Yeah.
So first of all, let us accept that retail is not a short-term player. And if you talk to people, really large distributors on the ground, and you should interview some of these people because they have a far better handle on the retail sentiment than the people who are actually managing the money. Okay. So they will tell you that retail in India is not looking at their prices every day. They're not your audience. They're buying the stocks and just going to sleep. Okay. And that's, the average holding period, I've done this computation, of Indian retail investors is 36 months. Nowhere on the planet do any class of investors hold stocks that long as the average investor in India holds.
And I remember you saying this for many years now, that the retail money is very sticky and it's only going to surprise on the upside.
Yes, so that is done. Okay, now as far as supply is concerned, yes, we had a little bit of bunching up, but that was in 2023. Okay, there was a bit of a bunching up that happened, and then things eased.
Even now we are seeing this, 4-5 deals every day.
But you have to add up the numbers and you have to divide it by the market cap. So whatever number you see, whether it's a weekly or a monthly number, if it's a monthly number, multiply it by 12 and divide it by market. That number, if it starts crossing 2.5-3%, then I will get worried. What is 2.5-3%? It's $10 billion of issuance every month for 9 to 10 months on the trot. We're not there as yet.
You're not there, of course.
Rhythm Desai there in an exclusive conversation there with CNBC-TV18. And take a short break. On the other side, we continue our conversation with Tata Motors' Managing Director Shailesh Chandra at their recent Harrier EV launch. Stay tuned. Welcome back. Still 50 points higher on the index. 24,600 is where we stand. 200 points higher on the Sensex, as Rima was highlighting. Railway stocks, RITES, Railtel, all of them doing well. Ircon is now up 8%, is moving higher and gaining strength as well. RVNL2 at the highest point of the day. RITES is up 6%. Mind you, RITES won an order yesterday. It is up 6%. Ircon has also now surged to the highest point of the day. And pull up Nava, and that is the top gainer on the Nifty 500 today. 12% higher on that stock. Nava Limited, and there you can see that 13% higher now on that stock, the top gainer on the Nifty 500. Also a couple of new listings as well that are doing well today. International Gemological Institute, IGI, 5% higher there as well, and Inventurous Knowledge Solutions, so IKS Health, that too trading with gains of around 5% in today's trading session. So quite a bit of strength seen in specific stocks in the broader markets today, when the Nifty though still continues to struggle to cross the higher end of its trading range. The Ashi Anand of IME Capital is now joining in to discuss some more sectoral ideas and his recommendations as well. Ashi, good morning. Thank you for joining in. You know, you can't not help but ask, because the flavor of the market has been defense and railways in the last month or so. Where are you positioned in both of these names, be it the shipbuilders, be it the railway names, or the traditional erstwhile legacy defense companies at the BELs and the HALs?
Sure, excellent. Firstly, thanks so much for having me on the show. This is definitely a space which is kind of looking interesting, and I think more so in the current kind of market environment, where across kind of other sectors, you are kind of struggling to kind of find growth at the current point in time. So in a market which is really struggling to kind of identify growth across other segments, both defense and railways do hold the kind of promise of increased government spends. Now, while overall government capex spends are kind of plateauing at some level and are kind of growing incrementally in line with GDP and with the budget, I think rail and defense are two areas where the markets still believe that the government can kind of continue to kind of spend disproportionately here. We currently do have defense in our portfolio. Amongst the kind of defense names, our preference is towards Bharat Electronics. Now, the primary reason for that is amongst the various PSU defense companies, it is the most diversified, and it's also the least kind of linked to specific kind of lumpy orders. If you look at a company like HAL, the orders tend to be very long tenured, very lumpy. Bharat Dynamics has seen a lot of kind of margin volatility in the past. We kind of see Bharat Electronics as a relatively safer way to play a theme, which we see to be very attractive over the kind of longer term. When it does come to rail, we have kind of looked at this theme quite closely. And our kind of concern is that you already have a fairly high base in terms of overall spends here. And the ability for spends to kind of grow disproportionately over the next 4 to 5 years to really account for the high valuations that some of these companies are trading at. We kind of prefer defense over rail there, because we just believe that in defense, the multi-year disproportionate growth story is a lot clearer.
Ashi, hi. Morning. Rima here. So tell us, almost half the year is done. Which theme has positively surprised you? Which theme has taken you by surprise negatively?
So I think it's not been a particularly positive year, right? As in, you've just had volatility up and down. I think the key theme, which has clearly kind of worsened over the last kind of 3 or 6 months, is specifically kind of IT services. We aren't speaking about digital here. We are speaking about IT services. I think no one really seems to understand what Trump is doing and the impact of various measures that Trump is kind of undertaking on the US economy. In that context, a lot of kind of US companies are holding back on spends, and this is clearly pushing back the growth recovery that we were expecting from IT services. So this is a space that has kind of clearly worsened a bit. Now, apart from that, I think from the start of the year to kind of 6 months down, right, and the 2 quarters kind of down, Q3 and Q4 results have recently just completed. I think by and large, what you are seeing is a lack of growth. You have some of the traditional kind of sectors which were struggling for growth earlier, right? So consumer is something where FMCG has been disappointing in growth for many years. A discretionary kind of consumption also kind of came in with kind of growth weakness over the last second half. And so I think sectors like kind of consumer, where growth was a bit weak, continue to be a bit weak. And I think the main thing we are kind of really trying to focus on is there were certain segments, capital goods, real estate, capital markets. Now, these were companies that were really driving the overall earnings growth of the market. Some of these have had a high base kind of catch up. And as compared to, if you're seeing a lot of real estate companies who are growing at 30 to 50 times on pre-sales, companies like a DLF, a Godrej Properties have now toned down those to kind of high teen kind of growth. It's still fairly attractive, but growth is coming off a bit there. So I think the one main thing we are really focusing on is where do we see growth? And we will very actively be positioning our portfolios towards segments where we are seeing greater signs of the growth recovery.
Okay, just one stock, in your digital portfolio, IndiaMart. I know it's not a significant holding, 4.5%, as I can see, but IndiaMart's numbers have been disappointing. They still haven't managed to close the churn, and start getting those quarterly paying subscribers, the metric that everyone tracks. And it's been, I think, close to about 3 years where the stock hasn't given any return. Since you have it in your portfolio and you assess it very closely, what are your thoughts on IndiaMart?
So just to kind of explain, even from a portfolio positioning perspective, our portfolio is, and we've discussed this in the channel in the past, it's kind of a quasi-private equity, long-term buy and hold form of a strategy. It's kind of weighted, the two core kind of weights that we have. One are the very large weights that we have in the portfolio. These tend to be 10 to up to even 20% weight in certain stocks. These are companies where kind of we're just very, very confident about the multiple kind of levers at play and the longer term growth story. We also do adopt a string of pearls approach where we have relatively kind of smaller weights in companies that are looking attractive either for the longer term growth story, but perhaps the competitive barriers to entry are not as strong as some of the other listed digital platforms, or kind of companies where valuations may be a lot more in favor. And kind of IndiaMart fits within that. As compared to a lot of your digital plays, which would trade at extremely high PEs, very often because earnings are depressed. IndiaMart can actually be valued on a traditional price to earnings multiple. If you're just looking at kind of financials, financials are actually not so much of the problem because what you have seen is with growth of new subscribers coming down, you've actually seen very attractive margin expansion as they've actually gone slow on new growth initiatives. However, the key kind of call is what can they do to rejig the silver kind of tier offering in order to make that more attractive to take care of the churn that they've been struggling with. Now, the reason IndiaMart does have a position in the portfolio is that if they do manage to address this, the stock is extremely attractively valued. So in our view, you are kind of discounting a lot of the kind of current concerns and you aren't factoring in for the fact that the management is looking at trying to address the solution. And if they do manage to find a solution to the churn, this is very clearly the most attractive and the leading B2B platform in the Indian digital space.
All right, Ashi, pleasure having you as always. Thank you so much for sparing time and joining us today. Looking forward to having you more often on the show. Well, still the index remains where it is and this broader market moves, of course, pull up Sare Gama, and that is now among the top gainers on the Nifty 500, 6.5% higher on that stock. Coforge is trading X its stock split today, and after that it's trading with gains of around 1.5%, some bit of volatility in the initial bit of the trading session, and since then it has recovered from the lows. Uno Minda is the other one, 4.5% higher there as well. And Swiggy, 4% higher on that stock, of course, still remains below its IPO price, But another good day for Swiggy. They're 4% higher now, nearing the mark of 350. We'll take a short break, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away. That's CNBC-TV18's all-new app, which gets you breaking news, in-depth articles and financial world updates, all of them at your fingertips. You can download the app from the Apple Store or the Google Play Store, or you can even scan the QR code that comes up on your screen and you can get that app on your phones. Take a short break, back on the other side.